Good afternoon, everybody. Pleasure to be with you. I'm going to share a big idea with you today. You get to decide whether it really is a big idea or not in the next 30 minutes or so. But let me first start by asking you a couple of very simple questions. First, do you believe the following? You don't have to raise your hands. Just ask yourself the question. Do you believe that businesses are at greater risk when multiple agencies manage their insurance programs? They have their benefits one place, P&C someplace else, maybe professional someplace else, and across the board. And of course, those agencies don't meet with one another to make sure things are coordinated. I think most people would agree with that. And then we take it one step further. Do you believe that most businesses are unknowingly at risk for potentially catastrophic claims, and it's off their radar screen? Talk to any producer that actually gets good access and gets in to take a look. It's a nightmare. And we're just lucky that bad things haven't happened yet to good people. Now, there's a number of cause and effects to what we all believe to be true, and I'm going to focus in on one today, the big idea that I want to share with you. And what we're seeing is that we have the P&C agents in one silo and the benefits people in another silo, and there are risks that arise between the two that don't get addressed. And we'll talk about that very specifically and how you can truly differentiate yourself in the marketplace. So we often ask this question: why don't P&C agents and employee benefits work together better? Now, some agencies will say, oh, we do it really well, but if that's true, that's the exception. I've been in agencies where we had P&C and benefits people in the same room, and the temperature is chilly and it's different, and it's not the same when you have one on the other side. And there's part of that is because there's just a different vernacular. They don't talk the same language. Co-insurance to benefits people is very different than co-insurance to P&C people, but that's not the biggest thing. The biggest thing is it's fear. I don't want to invite the P&C person in because they might mess up my client. I don't want to invite the benefits person in because they might mess up my client. It's fear, and it kind of goes to a half a loaf is better than none. That's what the big driver is. Now, I'm going to talk about integrating this a little bit differently than maybe you've heard it before, because the way this stuff normally gets integrated is the P&C or benefits person says, I got a guy I want to introduce you to. We don't want to do that. We want to get away from the, there you go, the I got a guy. And then what we've also found over the last 2 or 3 decades is cross-selling opportunities, or cross-selling initiatives, I should say, frequently underperform. I would say fail, but let's be kinder and say underperform. So why is that? Because what typically happens is a lot of people in the agency are told, well, you have to refer 4 accounts, or you're not going to get your bonus, or you'll get a spiff, or you'll get this or that and the other, and people are doing it just to check boxes, as opposed to positioning their colleague on the other side of the house to identify and help mitigate risks, of which there are many, and I'm going to talk about a few of them very specifically here in just a couple of minutes. This may or may not be resonating with you, but hang with me on this. Most cross-selling opportunities, cross-selling initiatives are just underperforming. We want to take a new look at that. And we're going to start here. Daniel Kahneman, by the way, he just passed away about a year ago. Won a Nobel Prize in economics, who essentially taught us all that we are more responsive and will be motivated to change. Nobody likes to change. Motivated to change to avoid bad things as opposed to be attracted to gains or good things. We want to avoid losses, not be attracted to gains. A lot of producers come with us and you'll get this, this, and this. Where agencies position them that way. We're going to talk about risks, because employers, as we just noted, are unknowingly at significant risk. So let's talk about the first risk that arises out of this cause and effect of benefits people and P&C people not working together well enough, or even understanding what's going on the other side of the house. And that comes right now with this paradox. It's a real paradox in our profession that property and casualty agents write the workers' compensation insurance. Benefits agents write the group health insurance. Well, the paradox is that work comp and group health are both employee benefits. Really, if we were to roll the clock back about 100 years and started selling work comp for the first time, it would likely be on the benefit side of the house. And what we find is that property and casualty agents typically don't know a whole lot about group health, and Same thing here. Employee benefits agents tend not to know a whole lot about work comp. What could possibly go wrong? Well, let's start with this. How many employee benefits people have ever seen a corporate officer exclusion under workers' compensation? How many benefits people are aware that they may have corporate officers, sole proprietors, LLC members, who am I leaving out? Partners that are excluded from the workers' compensation. A lot of benefits folks are not aware of that. A lot of P&C folks are not aware that this is an actual screenshot of an actual group health policy that says benefits will not be paid if it would have been paid under work comp. So how many people are running around today, officers, owners, partners, LLC members, and sole proprietors, not covered under the work comp because they could choose to exclude themselves? And some agents have put in their ear, well, you're not going to sue yourself. That's the nonsensical part of this whole thing. They don't have any medical coverage for injuries arising out of the course and scope of employment. Is that happening out there today? It is. If you meet a prospect and you discover this, the fear of that loss that they didn't know will likely drive them to you. We want to identify the risks that could be catastrophic that they weren't aware of. So ask yourself that question, check your books of business. Let's look at prospects in a different light, because it's just the way the training is aligned, that group health agents don't know about the officer exclusions and P&C agents don't know about the exclusions in the group health policy that frequently say, not everywhere, there's always an exception. We have a client in the room that in their state, their group health policy covers officers and owners, but you have to go look. How many P&C agents are saying, let me have a copy of your group health plan? Because without a copy of the group health plan, we really can't manage all the risks. Risk number 2, how many P&C agents are familiar with COBRA and FMLA? Not many. Well, why is that important? What could possibly go wrong if a P&C agent is not aware and knowledgeable on COBRA and FMLA? Let's take this scenario. Somebody's injured on the job. This is the group health policy. It says in order to be eligible to be on the group health policy, you have to be actively at work at least 30 hours a week. This is very common. And getting a W-2 or maybe a full-time owner or partner. That's in the group health policy of the guy that just got hurt. Is he actively at work 30 hours a week? He's on a no work status. He or she is on a no work status. Well, the work comp's going to be handled. It was an injury on the job. They're going to handle that. But what happens when we have a situation where now the spouse comes down with the dread disease? A child gets sick. Unless the employer has either triggered COBRA or FMLA for somebody out on work comp, there's no coverage under the group health plan. And why do you think I know this? You think I know this because I'm smart? No, not that smart. I know this because I've seen it happen. And we often have that recency bias that comes back and says, well, Frank, I've never seen that happen. Or crazy stuff like, well, the carrier would just go ahead and pay it. Yeah, the carriers are in the business of violating their own contract and paying claims that they don't have to pay. This is a big, serious issue. There's people out on lost time that no longer have group health benefits for anything other than, or medical benefits for anything other than the work comp claim that they're out on. Now, one little caveat to that to add to it, May 1st is right around the corner. This usually, you've got coverage typically to the end of the month, but on the next month is when it goes away. The first of the next month is when it goes away. So there's a big opportunity. People out on work comp claims, and their group health coverage has evaporated because does the work comp person know about the eligibility clause inside the group health policy that in order to keep them eligible, we have to put them on FMLA or COBRA? They typically don't know that. So we have people running around with no coverage. Now, I often get asked this question. Will employee benefit liability coverage respond? You know, I don't think a $300 endorsement is intended to cover that risk. We'd have to take a look at the form, but I don't think you can rely on it. Maybe a fiduciary liability policy, but we'd have to look at the policy. It's a big, serious risk. We'd have to just address it best. And of course, the big question to you is, how many employers are initiating COBRA or FMLA when somebody has a work-related injury? I never saw it happen. People tend not, I've had people call me before, I've had employers call me before and say, so-and-so's been out, we've had him on FMLA, he's not going to be able to come back to his regular job, how long do we have to pay his health insurance? And they just don't have any knowledge about whether they should trigger this on a work-related injury or not. Feel free to ask a question. It's okay, I'll take them as we go, take them at the end, really doesn't matter. Risk number 3, cyber. Now, cyber typically falls into the hands of the property and casualty agents. They're the ones having the conversations with the clients. Well, that changed, or should have changed, because what could possibly go wrong that employee benefits typically don't know about cybersecurity issues and cyber insurance, but mostly risk mitigation. Cybersecurity has always been in that P&C realm, but now the Department of Labor came out in 2021, even surprised people in government, that it is now a fiduciary responsibility. The Department of Labor is a little bit freaked out that we have trillions of dollars in 401k plans that could be hacked into and breached into. So they've put together a whole list of cybersecurity guidelines that anybody who's operating a benefit plan, whether group health or 401k, pension, whatever it is, they have to do 2 big things. One, they have to make sure their vendors report to them on a long list, checklist that the DOL puts out, that they're doing all these things, and then they have to do them themselves. So it's just not a matter anymore of we have to be concerned about cybersecurity and breaches. It's now a fiduciary responsibility and a fiduciary liability, and typically we're not seeing the crossover from the P&C folks to help out with the benefits folks, because this is relatively new. That's the quote right out of DOL. Responsible plan fiduciaries have an obligation to properly mitigate cybersecurity risks. It's relatively new, always a big change. It's now a fiduciary liability. And keep this in mind, employers don't have to experience a data breach to even be liable for the fines and the penalties. They don't have to have a breach. If they just haven't gotten with their group health carriers or their 401k administrator or their third-party administrator and said, I need you to document to me that you've done all these things. If they don't have that, at time of audit, they're liable. It's really true. One last thing. We're gonna have a couple of last things, so we're not ready yet. Because I know people often look at their watches about this time. This is the last one of the day, right? I think it's the last one, the last session overall. So let's talk about this briefly. This is one of the scariest statistics I see. 40% of employers with 3 to 99 employees are leaving the fully insured health insurance market to go into either level funded or self-funded plans, and level funded plans are self-funded plans. This is according to the National Association of Insurance Commissioners. Now, why do I find this so frightening? One, we've got employers as small as 3 employees, 10, 15, 20, 30 employees that are self-insuring their group health, self-insuring it. Now, they've been told such things that are patently untrue, that there's no greater risk in fully insured, in self-funded than there is in fully insured because of something called a stop-loss policy. Stop-loss policies are like every other policy. Exclusions, limitations, terms and conditions, and there's not a single stop-loss policy on the market that I've seen that says if the employer is responsible to pay the claim, we will reimburse subject to the deductibles. Doesn't exist. Tons of exclusions and the like. P&C folks need to be involved in this because benefits folks need help with fiduciary liability insurance. And when somebody goes into self-funding, the complexity of managing a group health plan has changed exponentially, and they're not being told. Another big extraordinary risk out there, 40% of under 100 employee firms, that's a lot of people. Self-funding probably should be reserved for folks that have 300 to 500 lives, but it's being sold down to a 5-person plumber. Insanity. really shouldn't be done, but if it's going to be done, let's at least try to help them out with some risk mitigation and some fiduciary liability insurance. Because the big misinformation that goes out with this and what's causing this rapid and massive growth is this statement. I redacted the source because the person's not here to defend themselves. Because of stop loss, self-funding is no riskier than fully insured health plans provided by an insurance company, quote unquote. That is said, that is in national trade journals. And the guy let him use his picture. It is, I promise you, that statement is unequivocally, metaphysically incorrect. I don't suggest that someone is lying. I see this so frequently that I even took some time to look up the definition of a lie. And it has to be purposeful misrepresentation. I don't think people know the difference. They're misinformed. They've been trained by carriers and group captive stop-loss carriers, and they've been told there's no greater risk because of stop-loss. Patently untrue. Clients are being left with significant exposure, and here's where it really gets ugly. How many P&C agents know about the federal law known as ERISA, Employee Retirement Income Security Act? It was 50 years old last year. Still, it's not on the radar screen with P&C agents. Benefits agents could use some brushing up as well, but it's a serious federal law. What makes it so serious? You could pierce the corporate veil and attach personal assets of the fiduciaries, which means anybody touching the group benefits plan, the group health plan, or the 401k plan, anybody who makes a decision around it, anybody who manages any part of it, anybody who helps an employee with it, they are a fiduciary. Now we don't just have the corporate or company assets at risk, their personal assets are at risk. You want to get somebody's attention. We were working with an agent in the Carolinas, and it was a multi-location automobile dealership, a prospect of his. Third generation, lots of wealth. Usually if you're a franchise auto dealer, you're wealthy or bankrupt. There's no in between. And it was going down to the third generation, and he met with the husband and wife team, and he talked about, has anybody shared with you how your personal assets are at risk in the way in which you manage your employee benefits plan? He was in there for the group health. And he said, well, that can't be. We got the best attorney and law firm in the state, and they've got everything lined up with LLCs and corporations. We've got so many moats around our castle, nobody can get to us. Have you ever heard of ERISA? Have you ever heard the federal law that says all of that could be cut through like a hot knife going through butter and go right after your personal assets? Now, nothing makes people more interested in changing to you than being wealthy and having it all at risk. Get a denied stop-loss claim for $3 million, even wealthy people are going to feel that. Oh, you don't have it in the company? We go to your house. We go to your kids, G.I. Joe with the Kung Fu grip. We're going to sell that. So this is serious business. This is very serious business, and a lot of P&C agents are not familiar with the personal asset exposure. I'm not so sure a lot of benefits agents are, but it's a huge opportunity. Something just came out this past week. There was a Supreme Court decision where it's going to make it easier for employees to sue on the excessive fees. You may have been reading about excessive fees. It started with 401k. The Supreme Court came out and said they're going to make it easier to have standing to sue on that. The comment in the National Trade Journal was fiduciary liability insurance is likely going to go up as a result. Right now, fiduciary liability insurance is not that costly. But a lot of folks don't have it. They're not aware. If anybody's in self-funded plan, well, any plan they should be, but especially if they're self-funded, they need to have a fiduciary liability policy and a lot of risk mitigation that goes with that. Here's another thing that's happening out there that I find shocking. It's been several years now since it came into effect, but employee benefits agents, unlike P&C agents, have to disclose all their revenue, all their commission, direct and indirect. So that's the straight up commission, that's their fees. And also, I saw this a couple of weeks ago. There was stuff all over LinkedIn about, look, my competitor's at the Masters. Of course they're going to give that carrier all the business now. And yeah, but did your competitor disclose the value of a trip to the Masters to their client? And if they don't disclose this, prior to the renewal, Prior to the renewal, they're in violation of ERISA. It's called a prohibitive transaction. And once the employer finds out that they don't have it and they weren't able to use that to decide whether or not the fees and the expenses were what ERISA calls prudent, the employer has to rat them out to the Department of Labor. They have to report their agent to the Department of Labor and end the relationship. I know of no other federal regulation that says you have to rat out your agent for not doing their job. I can promise you this is not being done well. And virtually every employer you meet, I always have to say with few exceptions, are currently in violation of ERISA, and they've not met this responsibility. Great opportunity for folks to go in and have that conversation. Any questions as yet? I'm okay with some questions jumping in the middle if you like. Everybody okay? I know it's late. Yeah, that's not happening. We're not seeing that happen. What could possibly go wrong with that not happening? One more last thing. And I was having a conversation earlier today, especially in states like New York and California, where small group is 100 employees instead of 50. Most states are 50 employees is a small group market. In New York and in California and maybe another state or two, it's 100. So that fully insured market is limited in flexibility for under 100 employees or even under 50. So what we're seeing is because of group health insurance, more and more employers are looking at, and we even have benefits agents in the game now, not just P&C agents, promoting professional employer organizations, also known as PEOs. Now, I will frequently say I'm not opposed to just about anything in the market. I'm just opposed to the lack of transparency around what a self-funded plan is or what a PEO is. When someone moves to a PEO, they typically do not have insurance policies anymore. They have a contract. They enter into a contract. And when they enter into a contract, the PEO says, we'll pay for your work comp claims unless we don't. And here's where we're not going to, especially when you hire a subcontractor and, lo and behold, that subcontractor was uninsured. State statute says you're responsible for the claim. PEO says, not us. We have in our contract that we're not responsible. And we can go on because you have to go through the contract. I've seen some of these contracts, they're draconian. So who would ever sign one if after they read it would be shocking to me. Many of the contracts say, we can cancel you with no notice for no cause. So now their payroll's wrapped up, their benefits wrapped up, their work comp's wrapped up, and they have a contract with somebody that says at 5 o'clock on Friday, I can call you up and say, we're done. Now I've just shut your business down. So, okay, maybe there might be some benefits having to do with the group health, but do you want to put your entire business on the line? Do you want to have where you're giving up protection for less protection? Now, in some states, you can get from your assigned risk pool a ghost policy, as they call it, right? If you can get that, that takes some of the risk off the table. If you can get a minimum premium ghost policy, that'll take some of the risk off the table. In some states, you can't get it. And here in the great state of Florida, our Joint Underwriting Association will sell you one, but still charge you for all the payroll. So you're paying twice. It doesn't work very well. So be very, very cautious. Look, I am very empathetic and understanding about the challenges that people face. Businesses, and now add to it all the uncertainty having to do with what's happening in the economic world, that they're looking for every opportunity to reduce costs, to be more efficient. But we can't lead them down that road and expose them to significant risks that they don't know about. If they knowingly and willingly assume them, well, I'm not going to worry about an uninsured subcontractor getting hurt because I never hire contractors that are not insured. Okay, you're assuming the risk though. You know it to be the case. This is a very different relationship. It looks and feels like an insurance relationship. It's not. They're not even regulated by the same people insurance companies and agencies are regulated by. In Florida, my home state, it's the Department of Professional Regulation, not the Department of Insurance. You know who else the Department of Professional Regulation regulates? Hairstylists and auctioneers. What are they doing so involved with making sure that companies stay solvent and their employees are taken care of? Sharing of responsibilities in a contract, and we have to read the contract. And I say this over and over again. Your client should never sign a contract as is. Should never sign a contract as is. There always has to be negotiation and a back and forth, because if you let your client sign a contract as is, I can assure you the other party had their attorneys leveraging it in their favor with little regard for your client's protection. There are hidden fees as well. I talked about some of the hidden risks, but oftentimes, they do this proposal that says, here's your cost and here's our cost. Well, it's not representative of anything outside of Disney World's Fantasyland. What they're putting on their proposal just simply does not exist. Now, you would think if you did something like that, you could lose your license. Why don't they? They don't need one. They're not required to have one. So there's nothing to lose. So be very, very careful about this option. Again, I won't say never represent a PEO, never put a client in a PEO, but I will say let's be far more diligent and far more transparent about the risks that our clients are assuming so that they can assume them knowingly. So let's recap. We have this big division between benefits agents and P&C agents. We have to cross that bridge, and not just because it's going to be about bonuses or checking the boxes or whatever the case may be. Clients are at risk if we don't bring these folks together. There's crossover risks that we have to address that can't get addressed. All the more reason to have it all under one roof, but then once you have it under one roof, you still have to coordinate. Still have to coordinate and help both sides of the house know what's going on the other side. And deal with the issues of corporate officer exclusions and group health. Deal with the issues of when someone goes out on a work-related injury, make sure people are triggering FMLA and COBRA to protect their benefits. Deal with the issue of cybersecurity, that now it's a fiduciary responsibility, not just a casualty issue. And deal with the issue of PEOs, because they're growing. They're growing largely because of what's happening in the group health market is a big stimulus to that. So what are we going to do about that? I would encourage you should have a handout on your desk or on your table with a series of questions that you can ask prospects just to open the dialogue. Just to open the dialogue, get them talking, what if you were to discover? What's your level of confidence? How would you feel if you were to discover this? How do you think wealthy people are going to feel when they find out for the first time their personal assets are at risk and they didn't know it? And they don't have anything in place to mitigate that risk. And they're self-insured when they shouldn't be self-insured. So I would strongly encourage that. So what do you do next? Well, you could do what Bruce said and roll down the window and let the wind blow back your hair, or you can get out on the street and tell the story. I want to thank all of you for joining us here today. I very much appreciate it. Be well. Peace and love.